Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section D. This is an application topic. Calculate the net property, plant, and equipment balances and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. What are you going to be doing on test day? You're going to be answering multiple choice questions and sims. You're not going to be watching a video lecture. You're not going to be reading through a textbook. So why not practice what you're supposed to be doing on test day, which is, again, multiple choice questions. So that's one of our main strategies. If you want to learn more about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam. Again, things like going to the questions first, studying in the morning before you go to work, making sure you review what you've studied previously every day, and things like that. Again, make sure you go check out our free 1-hour webinar and you'll learn about a lot of those things. And after you do that, you'll probably want to learn more about our other study bundles, like our materials bundle and our pro course bundle or our total bundle. So make sure you check that out as well. And just letting you know, today we're only going to be going over 5 questions, whereas SuperfastCPA CPA Pro members will have access to the full 10 question videos that we post in the members forum. So if you like this and you like our other materials, make sure you become a SuperfastCPA CPA Pro member and you will get access again to the extra 10 question video resources and other resources that we have so that we can help you pass these exams. With all that said, let's dive straight into the questions. All right, here we are at question 1. And just like I said in the previous video, where we talked about the gross value of property, plant, and equipment, we're now talking about how to calculate the net value of property, plant, and equipment. And that involves things like depreciation and depletion. I might make other videos about intangible assets and amortization. I'm not sure yet, but I'm definitely going to make this video, obviously, where we're talking about depreciation and a little bit about depletion. So let's go ahead and dive into these questions. One thing we always like to point out is always read the last part of the question first. This doesn't always work, but a lot of the time by reading this last part, you will get context that will help you for the rest of the question so you know what you're looking for as you're reading. So let's go ahead and read this last part. What is the net book value of the machinery at the end of year 3? Okay. Green Hill Corp purchased a piece of machinery on January 1st, year 1 for $850,000. The machinery has a useful life of 10 years and an estimated salvage value of $50,000. Green Hill uses the straight line depreciation method for the machinery. At the end of year 3, Green Hill is reviewing its financial statements. What is the net book value of the machinery at the end of year 3? Okay, so I've got to say, this is probably something you can do by yourself. Most people understand straight line depreciation. It's one of the most basic ways to think about depreciation and equipment and property and plant and stuff like that. So I think you could probably do this. Pause the video and do it yourself. If you have no idea how to do this, if you've never seen this before, that's okay. We're going to dive straight into the answer because that will inform us how to do this. And again, that's what we're doing throughout these videos, is using the questions to learn how to do the things that we need to do for the CPA exam. So let's go ahead and go to the answer. All right, the answer is $610,000. That's answer D. So let's walk through this. Again, this is one of the more simple things, so we're not going to talk too much about this one. To calculate the annual depreciation using the straight line method, you take the cost less the salvage value of whatever you're talking about, and then you divide it by the useful life, and that gives you the depreciation that you're going to have each year, and then you just have to do that each year. That's about it. So in this case, you have $850,000 of the cost of the machinery. You're expecting to salvage or, be able to sell it or break it down for $50,000 at the end of its useful life. And so that gives you $800,000 divided by the useful life of 10 years. That gives you $80,000 of depreciation per year. Since it's asking for year 3, we multiply the $80,000 of depreciation by 3 years, and that gives us $240,000 of depreciation or accumulated depreciation that has happened over the previous 3 years. So we take that and we subtract that from the cost of the machinery. We're not subtracting it from the cost less the salvage value because, again, remember, this depreciation is going to get us to the salvage value. So we've already taken that into account. So now we can use the normal cost of the machinery. So we subtract $240,000 of accumulated depreciation from the $850,000 that was the original cost, and that gives us $610,000. That is the net book value of the machinery on the books. So again, the machinery is sitting there at $850,000. The accumulated depreciation is sitting at $240,000, and when you net those, that gives you the $610,000 net book value. So that one, again, is one of the easier ones. Now we're going to talk about other depreciation methods that are more complicated and less straightforward. So let's go to the next question. All right, here we are at question 2. What is the depreciation expense for year 3? So basically the same question in the end, but it's going to be something different probably. Sunrise Corp purchased equipment on January 1st, year 1 for $300,000. The equipment has a useful life of 5 years and a $50,000 salvage value. Sunrise applies the double declining balance method for depreciation. So since we're using the double declining balance method, not the straight line method, this is going to be different than the straight line method, most likely, right? So we have to figure out what the depreciation expense would have been in year 3. And you'll notice this with a lot of questions that have to do with the net value of property. A lot of the time, they're not going to ask you what is the net value. They're going to ask you what the depreciation expense is for a certain year, because if you know how to do that, then you know how to calculate the net value of something, because you know how to get the depreciation that gets you to that net value. So a lot of the time you'll see questions asking about the expense rather than the net value, but just pay attention to that. So again, we're trying to figure out the depreciation expense using the double declining balance method. If you know how to do that, that's fantastic. I think that a lot of these depreciation methods are kind of weird, but again, if you know how to do it, go ahead and pause the video and try to do it yourself. If you don't know how to do this, that's okay. We're going to look at the answer together. All right, here we are. The answer is B, $43,200. So let's walk through this. It's not too difficult. You just need to know how this works. In the double declining balance method, the depreciation rate is twice the straight line rate. For a 5-year useful life, the straight line rate is 1 out of 5, or 20% each year, right? But with the double declining rate, we use double that rate, so it's going to be 40% each year. Now, one thing I want to make sure you realize, we are not doubling the straight line depreciation amount each year. So, for instance, with the straight line depreciation method, if we have $300,000, and if 20% of $300,000 is $60,000, we're not going to every year do $120,000, which would be doubling the amount. We're doubling the percentage. I just want to make sure that that's clear, because again, we're not doubling the $60,000 that you would have on straight line depreciation. You're doubling the percentage that you would have on straight line depreciation each year. And let me kind of clarify that with the depreciation calculations here. So for year 1, 40% of 300,000 is 120,000. So in the first year, yes, you are doubling what I was talking about, but you're not going to do that in the next years. So let's continue. So net book value for year 1 is the $300,000 less the $120,000. That gives you $180,000. Now in year 2, again, we're not doing $120,000 again. We're doing 40%, which is double the 20%. So 40% of $180,000 is $72,000. That's the depreciation. We subtract that from the $180,000, and that gives us a net book value of $108,000. Now in year 3, we have, again, 40% of $108,000, and that gives us $43,200. So that is the depreciation for year 3. Now, you'll notice that we did not take the salvage value into account. We didn't say 300,000 less 50,000, so we didn't use 250,000 for this. We just used the straight cost. But the salvage value does come in at the very end. And so let me kind of explain this note. When using the double declining balance method, you do not take into account any salvage value until the accumulated depreciation would cause the net value to go below the salvage value. At this point, you stop taking depreciation because you can't go below the salvage value. Now, what does that mean? That means that in year 3, we've taken another $43,200 of depreciation. That means that there is $64,800 of net book value left. Now, if you'll pay attention, that is still above the salvage value, but if in the next years, the depreciation would cause it to go below that salvage value, you just take depreciation up to the salvage value, and then that's it. So if there's randomly a year where you're already at the salvage value, then you don't take any more depreciation. There's no more depreciation from that point onward. You stay at the salvage value. So I just want to make sure that that's clear. You probably won't see a question like that, but you may. So just make sure you understand that at the beginning, you don't take the salvage value into effect, but as you're depreciating throughout the years with this double declining balance method, you cannot go below the salvage value. So just make sure you understand that. That's the double declining method. Let's go to the next question. All right, here we are at question 3. What is the depreciation expense for year 3? So all of these have had the same last question. So again, that doesn't always help, but a lot of times it does give you context. I promise. It's a good habit to be in. Let's go up to the top. Harbor Industries purchased a piece of equipment on January year 1 for $240,000. The equipment has a useful life of 8 years and an estimated salvage value of $20,000. Harbor uses the sum of the year's digits method to depreciate the equipment. Now, this is one of the methods that I think is kind of ridiculous, but it does exist, and you may be asked about it on the exam. So if you know how to do this, just based off of the name, think of the name sum of the year's digits. You could maybe figure out how to do this based off that, but if not, that's okay. I think this is one of the more complicated ones and more convoluted ones. So we're going to go through it together to make sure that you understand it. Again, if you want to try yourself, go ahead and pause the video, but if not, let's go to the answer. All right, here we are. The answer is C, $36,667 is the amount of depreciation you're going to take in year 3 using the sum of the years digits method. Let's walk through this. Again, I think this is kind of a convoluted one, but I don't think it's too difficult once you understand how to do it. In the sum of the years digits method, depreciation is based on a fraction where the numerator, so the top, is the number of years remaining in the useful life. So let's say you have a useful life of 8 years and you haven't started any depreciation yet. That means in the first year, you still have 8 years of depreciation left. So that would be the numerator. And the denominator is the sum of the digits of the total useful life. So what does that mean? The sum of the years digits is this. You take in year 1, there's still going to be 8 years left. In year 2, there's still going to be 7 years left of depreciation. In year 3, there's still going to be 6 years of depreciation left, and so on. So 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. So you add all the years up, and that gives you 36 as the denominator. Now, what do you do with this? Again, you take the number of years remaining and put it over that denominator, and then you'll be able to use that to figure out how much the depreciation is for each year. So let's go down here and kind of start doing that. Depreciable base is the $240,000 less the salvage value of $20,000. So you do take the salvage value into account with this method. So $220,000. You multiply $220,000 by, again, the remaining useful years left over that 36, which is the sum of the years, 8 all the way down to 1. So 8 divided by 36 multiplied by 220,000 gives you $48,889, and that's rounded, dollars of depreciation for year 1. So we now have a net book value of $191,111.11 technically. So we take that, and that is the net book value. We go to year 2. In year 2, again, now it's year 2, so there's only 7 years left of depreciation. So 7 divided by, again, the 36, which is the sum of the years digits. Multiply that by $220,000, and that's $42,777.78, or, $78. That is the depreciation for the year. So that gives us a net book value now of $148,333.33. So in year 2, that's the net book value. Now we can finally get to year 3. We had to do all that to be able to know what year 3 was going to be. Year 3, again, there's still 6 years left of depreciation. So 6 divided by 36 multiplied by $220,000 is $36,666.67, or really, maybe rounded up to $67. And that would give you the net book value of $111,666.66. Now, that wasn't what the question was. We didn't need to know the net book value of year 3. Now, if you notice, depending on what the question asks, if it's asking for the net book value, yes, you're going to have to do this. And that's why I included it there so that you could see what was occurring each year. But if it's only asking for the depreciation expense, then technically you could just do just this calculation right here. You wouldn't even have to do the first calculations if you can kind of think in your head through it. Because, if it's year 3, then that means that there's only 6 years left of depreciation. So you could just immediately do this 6 divided by 36 multiplied by 220,000 and get this depreciation for year 3 without having to do any of this. So just think about that. Make sure you kind of keep that in mind when you're doing the sum of the years digits and they're asking you to calculate the depreciation. But if they're asking you to calculate the net value, then yeah, you're going to have to do every single part of this till you get to the correct year. And that's why I included all of it so that you could see the actual process, see what was actually happening. But if you remember how to do this, you can just kind of cut straight to the depreciation for that year because you already have all you need once you figure out the depreciable basis and the sum of the years. So something that I just wanted to point out there. Now let's go to the next question. All right, here we are at question 4. What is the depreciation expense for year 1? Oh, a different year, not year 3 anymore. Brighton Corp purchased office furniture on July 1st, year 1 for $100,000. The furniture has a useful life of 10 years and an estimated salvage value of $10,000. Brighton applies the straight line method for depreciation and uses the half-year convention. So what is the depreciation expense for year 1? So this is the straight line method, and we've already talked about that in question 1, but it is mentioning the half-year convention. If you don't know what that is, then you might not be able to figure out this problem, but I think if you just think about what the half-year convention means, you could probably figure out the correct answer, and then we'll kind of go into the explanation to explain why that's the correct answer. But I think you could probably figure it out. Pause the video if you need to. If not, again, let's go to the answer and look at it together. All right, here we are at the answer, A, $4,500. So let's go ahead and look at this explanation. The half-year convention assumes that assets are placed in service halfway through the year, regardless of the actual purchase date. This means only half of the annual depreciation is taken in the first year and the last year. And by the way, don't get worried that I'm going to start talking about the mid-quarter or the mid-month convention or whatever that is, that's mainly a tax thing. So we're just talking about just the half-year convention here, and it's not a super big thing. It's not super difficult. Basically, what you do is you still figure out, because you're using the straight line depreciation method, or this could be applied with any of the depreciation methods probably, but we're using the straight line depreciation method. You figure out the normal depreciation that you would have each year, and that's the cost less the salvage value divided by the useful life. So that would be $9,000 in this case. Since the half-year convention applies, Brighton will only take half of the annual depreciation in year one. So in year one, instead of $9,000, they're only applying half the depreciation, so it's $4,500. So it's that simple. Now, what does that mean? That means that for years 2 through 10, they are applying the $9,000 of normal depreciation, and again, that will be taken each year. But this will still leave $4,500 left to depreciate after year 10. So it's 10 years of depreciation, but because we're only applying half of it in the first year, we still technically have, in year 11, $4,500 left that we need to depreciate. And so we have to depreciate that because that will then leave the salvage value of $10,000. So technically, when you use the half-year convention, there's actually 11 years that are going to have depreciation, because in the first year, you're only doing half. So once you get all the way down to year 10, there's still the other half of depreciation that wasn't applied in the first year that you have to apply in the next year. So something that you have to kind of think about there. But again, this is not a difficult topic. Just think half year. That means you do half the depreciation in the first and in the last year of the depreciation. It's that simple. Let's go to the next question. All right, here we are at question 5. What is the depletion expense for year 1? Okay, so like I said at the beginning of the video, we're talking a little bit about depletion. So this is going to be the depletion question that we go over. Let's read the rest of it. Forest View Lumber Co. purchased a plot of timberland for $400,000. The company spent $150,000 to develop access roads and infrastructure, and they estimate that restoration after logging will cost $80,000. And by the way, that is something that's very common when it comes to purchasing land that you're going to be taking resources out of. A lot of the times it's required by the government or by an organization that you have to restore it as best you can to what it was previously before you started taking the resources out of there. So this is a very common thing. Forest View expects to sell the land for $100,000 after restoration. The timberland is estimated to contain 50,000 tons of harvestable wood. In year 1, Forest View harvested 10,000 tons of timber. What is the depletion expense for year 1? Okay, so again, this is depletion. It's not depreciation. This is one of the few times where land is actually going to lose value on the books. It's not quite the same. And again, you cannot depreciate land, you deplete land, because land is different. Land is always going to be there. Anyway, if you know how to do this, that's great. Pause the video. But if not, again, this is a little bit different. We'll go to the answer and kind of learn how this works. All right, here we are at the answer. The answer is D, $106,000 is how much the depletion will be in the first year. So let's walk through this. It's not too difficult, so let's go over it. First, you have to calculate the depletion base, like how much is the original base that you are depleting each year as you take the material out. The depletion base is the purchase price plus the development cost, so anything that you have to spend to get it ready to be used and to be harvested. Then you add the estimated restoration cost. So again, like I was saying, that's a very common thing. You a lot of times have to spend money to restore it to its original state. So that's going to be a part of the depletion base. And then you subtract any expected salvage value, or, that might have a different name according to some people. But overall, this is how much money you're expecting to get after you sell it. So it's very similar to salvage value. So that's why I use salvage value. So $400,000 plus $150,000 plus $80,000 less $100,000. And that $100,000 is again how much they're expecting to get after they sell it, after they've used it. So all of that together is $530,000. So that's the depletion basis. Now we can figure out the cost per ton so that each ton that's taken out is going to be a part of the depletion. The depletion base divided by the total tons of harvestable wood, so that's $530,000 divided by 50,000 tons that they think they can harvest, and that's $10.60 per ton that is going to be depleted from this depletion basis, or this depletion base. So now let's go down to year 1. The depletion expense for year 1 is the cost per ton, which we calculated here, multiplied by how many tons they harvested in year 1. So that's 10,000. So 10,000 tons harvested in year 1, and each ton is depleting the depletion base by $10.60. That means that the depletion expense is $106,000. So that's how you calculate the depletion expense, and you could also calculate the land's net value based off of that. But again, it asked for the depletion expense instead in this question, so that's what we did. And with that, we've gone over a lot of different things. We've gone over multiple different depreciation methods and talked a little bit about depletion. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, again, that's what we're using as our main learning source, you are going to see things that keep popping up. You've seen 3-4 questions trying to teach you how to do the double declining balance method, or you've seen 2 or 3 or 4 questions teaching you about depletion, or whatever the case may be. These are obviously the most important things that you see from multiple questions that keep popping up. So you take a moment and you write down these important topics, these pillar topics, you summarize them in your own words so that you know what is most important from what you learned that day. And as you do this each day, you will build up pillar topics, you will build up the most important things that you need to know for the exam so that you then know it for the exam. So let's go to the pillar topics for this video. All right, here we are at the pillar topics. Again, this is just a summary of how to do things or what the most important things are. So straight line depreciation calculation, this one's really easy. Depreciation is calculated by subtracting the salvage value from the asset's cost and dividing it by the useful life. This results in an equal depreciation expense each year. That's the normal one. You've probably all done that, so not too difficult. Double declining balance depreciation calculation. This depreciation is calculated by doubling the straight line rate, again, not the amount, the rate. So if it was 20% for the straight line method, it'd be 40% for the double declining, and applying it to the asset's beginning net book value for each year. This method does not take into account the salvage value at first, but the depreciation cannot take the net value of the asset below the salvage value. So you don't subtract the salvage value at the beginning, but as you're depreciating, you have to notice and know what the salvage value is so that when you get close to that, you don't go below that and you just take the depreciation up to that salvage value and then that's it. Sum of the year's digits depreciation calculation. Depreciation is calculated by multiplying the depreciable base, which is just the cost less the salvage value. You multiply it by a fraction, and the fraction is where the numerator is the years remaining in the useful life. So if it's the very beginning, let's say the useful life is 8 years, that means that this numerator is going to be 8 years because it's right at the very beginning. And then the denominator is the sum of the years of the useful life. And what does that mean? That means if you have a useful life of 8 years, or let's do 5 years. If you have a useful life of 5 years, in the first year, there's going to be 5 years left. In the second year, there's going to be 4 years left. In the third year, there's going to be 3 years left. In the fourth year, there's going to be 2 years left. And in the fifth year, there's going to be 1 year left. That's the last year. Now, if you think about that, that's 5 plus 4 plus 3 plus 2 plus 1, that gives you 15. That's how you add that all up together. And so that's going to be the denominator. And you, again, take the how many years are remaining in the useful life divided by that denominator, and you multiply that by the depreciable base, not by the net value of each year, but by the depreciable base, and that gives you how much depreciation there is for each year. Now for the half-year convention, the half-year convention assumes that assets are placed in service halfway through the year, resulting in only half of the annual depreciation being recorded in both the first and the final years. And then there's land depletion. Depletion is calculated by adding the purchase price, the development costs, and the restoration costs, and subtracting the salvage value, dividing all that by the extractable resources that they're expecting, like the total extractable resources that they're expecting to be able to take out. And then you multiply it by the resources that were actually extracted in the year. That's how you calculate how much the depletion expense is for the land in that year. Again, depletion isn't as big of a topic as depreciation or amortization, but it is important to still know how to do it. So that's why we went over it. And with all that, we've gone over the pillar topics for this video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Make sure you go sign up for that because, again, it's only 1 hour, it is free, and we will show you the key ingredients to passing the CPA exam. And then after that, you're going to want to learn more and you're going to want to buy our other products, but, go watch the webinar first. But just remember that in this video, we only went over 5 questions, but just know that SuperFast CPA Pro members will have access to the full 10 question videos when we post them in the members forum. So again, if you like this, if you like our other products, become a Pro member and you will get access to a whole bunch of great resources, especially the Pro course, but you also get access to the 10 question versions of these videos that will be very useful to you. So make sure you go check that all out. If you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.